$17.94 trillion. That is not the national debt. That is not government spending. That is not some number buried in a congressional budget report no one reads. That is the total amount of debt sitting on the shoulders of ordinary American households, right now, today, and it just hit the highest level ever recorded in the history of the United States. Let that sink in for a second. Every mortgage, every car payment, every student loan, every credit card balance carried past the due date, every buy now, pay later scheme, every medical bill on a payment plan, add it all up, and you get nearly $18 trillion, and the pile is still growing. Now, numbers that large can feel abstract. They can feel like something that happens far away, in spreadsheets and central bank meetings, not in your kitchen, not in your driveway, not in your mailbox. But here's what I need you to understand before we go any further. This is not abstract. This is personal. This is structural. And the pattern we are watching unfold right now rhymes, in chilling detail, with the pattern that preceded the worst financial disaster in a generation. We have been here before, and last time almost nobody saw it coming, or at least almost nobody admitted they did. Let's start with the basics, because the full picture requires you to understand what kind of debt we are actually talking about. The largest piece of American household debt is housing. Mortgage balances now stand at over $12 trillion. That is the foundation, the bedrock of the debt stack. And for most of the past decade, rising home prices made that feel safe. If your house is worth more than you owe, you feel okay. You feel wealthy, even on paper. But beneath that seemingly stable foundation, the smaller categories of debt are where the real warning signs are flashing. Now here's the part no one is talking about. Credit card debt just crossed $1.17 trillion. That is a record. In the second and third quarter of last year alone, Americans added tens of billions of additional balances to their cards. And the average interest rate on those balances? Over 21%. 21%. That is not a loan. That is a trap. Auto loan debt is sitting at around $1.6 trillion. And delinquency rates on those loans, meaning people falling 60 or more days behind on their payments, have shot up to levels not seen since right after the 2008 crash. Student loan debt remains near its historic high of approximately $1.6 trillion. And after the pause of the pandemic era ended, millions of borrowers were thrown back into repayment with no soft landing, no buffer, and in many cases, no plan. And then there is the newer, quieter threat, buy now, pay later loans, which are growing explosively and largely exist outside of the traditional credit reporting system, meaning regulators and economists don't even have a complete picture of how much of this debt exists or who is holding it. So when you look at the full landscape, what you see is not just a large number. You see a debt structure with a solid core on top, and increasingly unstable, high interest, high delinquency layers underneath. And those layers are cracking. Now let's talk about 2008, because I know some of you are thinking, people always compare things to 2008. It's become a cliche. Every market hiccup gets compared to the financial crisis. So let me be specific about what I mean when I say the warning signs look similar, because the comparison is not casual. It is precise. In the years leading up to 2008, the problem was not simply that people had too much debt. The deeper problem was that debt had been extended too easily to people who could afford it only under perfect conditions. And when conditions stopped being perfect, the entire system began to unravel. What characterized the pre-2008 environment? Loose lending standards, aggressive credit extension to borrowers with deteriorating financial health, rising delinquency rates in subprime categories, financial products that obscured risk rather than managed it, and a widespread assumption that rising asset prices would continue to mask the underlying stress. Sound familiar? Here's the data that should make you uncomfortable. The Federal Reserve Bank of New York tracks what it calls the transition rates on debt, meaning the percentage of debt that moves from current to delinquent to seriously delinquent each quarter. In 2022 and into 2023, those transition rates for credit cards and auto loans began climbing. Not dramatically at first, just gradually, a few tenths of a percent here and there. But the direction was unmistakable. By late 2023 and into 2024, those delinquency transitions had accelerated. Credit card delinquency transition rates reached their highest level in over a decade. For borrowers under the age of 40, the deterioration was even more pronounced. And here's the part that economists quietly worry about most. Delinquency rates almost never spike suddenly. They rise slowly, then they rise faster, then they rise very fast. We are currently in the middle phase. The slow rise has happened. The acceleration has begun. And this is where things could turn very fast. Whether we reach the third phase, the rapid deterioration that triggers broader financial stress, depends on a set of factors that are not fully within anyone's control. 3 variables, and all 3 are shifting at the same time. The first is employment. As long as people have jobs, they can generally service their debt. They may be struggling. They may be paying the minimum. They may be juggling between cards. But they are keeping the lights on. The moment unemployment rises meaningfully, debt stress transforms into debt crisis. Every percentage point increase in the unemployment rate represents millions of people who go from barely managing their payments to completely unable to make them. The labor market has remained surprisingly resilient, but it is showing early cracks. Layoff announcements in the technology sector, retail consolidations, and softening job openings data are all signals worth watching. The second variable is interest rates. The Federal Reserve raised rates at the most aggressive pace in 40 years between 2022 and 2023, bringing the federal funds rate from near zero to over 5%. The purpose was to fight inflation. But the side effect was that the cost of carrying variable rate debt, credit cards, adjustable rate mortgages, home equity lines, exploded. People who were making minimum payments at 14 or 15% interest rates suddenly found themselves trying to pay down balances at 21, 22, 23%. The Fed has begun cutting rates, but the pace has been cautious, and the relief for consumer borrowers has been minimal so far. The third variable is the wealth effect, particularly the housing market. One of the reasons this situation has not already tipped into crisis is that home values have remained elevated. For homeowners, that creates a psychological and financial buffer. They feel like they have equity. They feel like they are okay. But if housing prices soften meaningfully, and there are signs in certain markets that they are beginning to, that psychological buffer disappears. And for the roughly 35% of American households who rent and have no housing equity, there is no buffer at all. This is where the class dimension of this story becomes impossible to ignore. The household debt crisis is not evenly distributed. It is concentrated. It is concentrated in younger borrowers who entered the workforce during a period of soaring costs and stagnating wages. It is concentrated in lower income households who rely on credit cards and payday loans to bridge the gap between what they earn and what it costs to live. It is concentrated geographically in regions where the cost of living has risen faster than local wages. And it is concentrated in communities of color, where a combination of historical wealth gaps and predatory lending practices has left many families with thinner margins and fewer options. When economists talk about aggregate household debt, they are averaging across a population that includes both people who carry zero debt and own their homes outright, and people who are 3 payments behind on a used car they need to get to work. The average number obscures the distribution. And the distribution is where the danger lives. If you value data-driven economic breakdowns like this, consider subscribing. It helps more than you think. Now I want to address something directly because you may be sitting there wondering, if this is all true, why aren't we seeing more urgency from the government, from the Fed, from Wall Street? The honest answer has multiple parts. Part of it is that financial institutions have strong incentives to project calm. Markets are confidence games at some level. Acknowledging risk explicitly can accelerate the very crisis you're trying to avoid. Part of it is that policymakers are genuinely watching and genuinely uncertain. The signals are real, but the timeline is not clear. This could be a slow-motion stress that takes years to fully materialize. It could stabilize if conditions improve. It could accelerate suddenly if an external shock, a major employer collapse, a geopolitical disruption, an energy price spike, hits at the wrong moment. And part of it, frankly, is that the institutions most responsible for extending credit have also profited enormously from the boom. The major banks posted record profits in recent years, in part because of the interest income from higher rates and growing balances. When the people sounding the alarm are also the people who benefit from the status quo, the alarm tends to be quiet. Let me bring this back to the individual level, because ultimately, macro trends only matter insofar as they affect real people. If you are currently carrying significant high-interest debt, particularly on credit cards, the most important financial priority you have right now, more important than investing, more important than saving for retirement, more important than almost anything else, is reducing that debt. At 21% interest, every dollar of balance you carry is costing you 21 cents per year in pure financial decay. There is no investment that reliably beats that math on a risk-adjusted basis. If you are a homeowner with an adjustable rate mortgage, you should understand exactly what your rate is, when your adjustment period is, and what your payment would look like at higher rate scenarios. If the numbers frighten you, talk to a financial advisor or a HUD-approved housing counselor today, not when the adjustment happens. If you are someone who has been using buy now, pay later services regularly, pull back and get a full accounting of what you actually owe across all of those platforms. These services are designed to be invisible until they aren't. And if you are someone who has been watching their financial stress increase and wondering if it is just them, if you're feeling ashamed or alone, understand that what you are experiencing is being experienced by tens of millions of Americans simultaneously. This is a structural problem, not a personal failure. That does not make the bills go away, but it does mean that the solutions need to be structural as well as personal. We are at an inflection point. The data is clear. The trajectory is concerning. The parallels to historical patterns of credit excess and deterioration are real and documented, not invented or exaggerated. What happens next depends on a combination of policy decisions, market forces, employment trends, and the accumulated choices of millions of individual households, some of which have options, and many of which do not. The most dangerous thing you can do right now is nothing. The second most dangerous thing is to assume that because a crisis has not arrived yet, it is not coming. In 2006, at the height of the housing bubble, the financial system looked stable from the outside. Banks were profitable, unemployment was low, consumer spending was strong. Everything looked fine, right up until it didn't. The cracks in the foundation are visible today. If you know where to look, you now know where to look. Stay informed, stay prepared. And do not let anyone tell you that nearly $18 trillion of household debt is just a number. Numbers have consequences, and this one is coming due.